welcome to the new channel. I'm Nick, also known as the Ginger Accountant. This is my new channel, and I don't really know what I'm going to be doing with this right now. This is all really new, and I just seen this vid and listened to this podcast, and I thought I need to do a reaction vid to it. And I'm thinking of making it into a new series. So this isn't going to be perfect, and by no means is it going to be any good. But I've listened to this podcast episode a couple of weeks ago, and I was like, this is gold. There is so much to dive into and to break down in this around financial empowerment and what that means for women in particular. And I align with this podcast so much. So I'm going to be looking at a couple of different ladies who launch episodes and doing a couple of reviews on them. But I wanted to kickstart it off with this financial empowerment one because I just thought it was brilliant. So we're going to dive into it a little bit more and, really find out more about this. So let's go.
Welcome back to the launch box.
I'm sorry, but how good was that intro? That intro was like proper vintage, like woman power, like Marilyn Monroe. Like, I love that. That was brilliant.
Episode, we're joined by the incredible Bola Sol. Bola is a financial advisor and author. She is so passionate about helping people take control of their money and mindset. And today she's here to share her insights on financial empowerment, building wealth, and the importance of financial confidence.
Also, before anybody shoots me, I watch with subtitles, and I'm not sorry about it because I'm very visual, love to read as I'm listening.
Welcome to the podcast, Bola Sol. Just a quick one before we start. If you like listening to this episode, which I know you're going to, please like much for coming and talking to us. I think the best place to start is breaking it down, exactly what you do, Bola, and how that looks, because you're a financial advisor.
Yeah.
I think there's that confusion between a financial advisor and an accountant,
Yes.
which is really interesting.
This is so true. And it's not just women that get this confused, it is men as well. An accountant and a financial advisor aren't the same. And I'm going to tell you the difference right now before they start breaking it down. An accountant is going to help you with your compliance. They're the ones that guide you through your business, that can advise you on your business, where to spend your money, how to create a budget, what to do with your bookkeeping, where to code transactions, sorting out your profit and loss, sorting out your balance sheet, submitting your accounts, submitting your tax return, making sure that you're being tax efficient. That is an accountant. That is very simple what an accountant does. A financial advisor is still very important, but their jobs aren't the same, but they work together. A financial advisor deals with investing. So investing in the stock market, investing in pensions, different areas where you can grow your money and make your money work for you, whereas an accountant helps you look after your money. So that is my differentiation between an accountant and a financial advisor. Now, the reason why they work together is because we're both trying to save you on tax. So a financial advisor needs to give the accountant numbers in order to save for tax. But you can save on your limited company minimum 60k by putting it into a private pension, which an accountant can't do but can advise you that that is a strategy for you to use, but goes to a financial advisor that will actually take that 60k out of the limited company and go and put it into the right pension. That's how it works.
Tell me what your job role actually means.
Yeah, well, thanks for having me.
Thank you.
I would say with a financial advisor, we help people look after their investments.
There you go.
So we call it assets under management, and we may have a starting figure. So somebody could come to me and say, for example, someone's left me an inheritance and I now have so much more money than I know what to do with. You know, you might know what to do with your paycheck every month, but what do you do if maybe someone's left you £300,000? That's when a financial advisor could come in. It can be a lot less than that, by the way, but the whole point is we come in, we assess your attitude to risk, your capacity for loss, and then we will put together a presentation of what we think we should invest in on your behalf, and then that's what we'll do. And maybe we'll have meetings once or twice a year, catch ups, and be like, this is where your money is now and this is how your money's growing. What's interesting is, if we work with someone like that, we tend to ask, oh, do you have an accountant? Who's your accountant? And then we ask, can we get in touch with them? Because we also want to make sure that you are being tax efficient.
Exactly. We are not the same. We are different, but work together. We are separate in our own rights. We have different bodies, different qualifications that we need to go through as an accountant and to what a financial advisor does. So for an accountant, we go through... There's a variety of things. You can go get a degree, obviously. That's not the route I took. I went through the apprenticeship route. So I got an apprenticeship studying AAT, which is the Association of Accounting Technicians. That is your base, really. So you have 3 stages of qualification that you can go through with the AAT, level 2, 3, 4. 4 is basically equivalent to like a foundation degree, if you like. But still, you can get licensed through them once you become level 3 or level 4 qualified. You are licensed in different capacity. Level 4 is an accountant level, and really that is a stepping stone for you to go and do either ACCA or CIMA at a later date, but it's a completely different infrastructure and qualification that you go through as to a financial advisor.
So, of course, that's what we have to do, but we just want to make sure that everything's aligned so they can work together.
Yeah, so different, but they coexist.
Yeah, exactly.
Yes.
Exactly.
Coexist.
We've all just paid our taxes. And I see it so much in my industry with like friends and people that I work with that we're like, gosh, I've got to get everything sorted because I've got to get tax return in. And it's like the moment that everybody goes, it really is. And we know it happens every year. We know it's coming. We don't get any better at organising for the year end.
Yep, and that's true. And that's true. Sing the praises for that, because it happens so often where that 31st of January, every single year, your tax return, your self-assessment tax return, so your personal tax return, is due for submission to HMRC as well as payment. Final payment is due. When you are self-aware to know that you've got, not even so much being self-aware, it does take a level of self-awareness, but the thing is, it doesn't change. It's the same every year, and you're leaving it in a cycle to the last minute. That's when big debts get run out, that's when mismanagement happens, that's when you lose the chance to claim back stuff and be tax efficient, because it's too late. By that point, it's too late. You can only be tax efficient during the tax year. So at the moment, the date is the end of April. The end of April. So this is a perfect example to actually give, because we have just started the tax year this month. So tax years start on the 6th of April every single year and finishes on the 5th of April. So at the moment, 6th of April 2025, we're currently at the end of April. So we are in tax year 25 to 26, because this tax year doesn't finish until next year on the 5th of April 2026. Now, tax year for 24-25 is gone because that finished on the 5th of April 2025. You with me? You staying? You know what I'm on about? Cool. So because that is now finished, there is nothing that you can do to save on tax for that tax year. It's gone. It's done. It is what it is. But what you can do is make sure that you've got all of your receipts and you claim back all your relevant expenses, and you are making sure that you are being as tax efficient as possible with that kind of stuff. However, the best time to be tax efficient is in the moment. It's throughout the year, rather than waiting right until the end to scramble and to try and pick all of them receipts up and to try and put that money into a pension or to try and max out your ISAs. Don't get me wrong, there is still always going to be that sprint at the end of the tax year, but leaving your tax return 9 months, because that's how long. So from the 5th of April, we have 9 months until the 31st of January 2026 to submit and sign that tax return and get it paid. Why do we leave it to the last minute? And it's usually because of a fear. It's because you don't want to have to face the fact that you've got to pay tax. A lot of people don't even want to pay tax. And I've actually had people say to me before that they don't want to go over the 90k VAT threshold because they don't want to pay that. And it's crazy to me. Like, I I am a true believer. You don't set up your business to recreate a 9 to 5. You set up a business for you to live financially, flexibly free. And by recreating a 9 to 5, you're not doing yourself any justice. And you're not helping yourself in any way tax-wise at all, because you're literally leaving it to the last minute. Like, you're not putting 20% aside. You're not saving for it. Like, it baffles me. It happens so often.
It's just how it works, right? If we're at the time, and we're probably all having the same conversation now, where we're like, next year I'm going to be ahead of this.
Yeah.
Next year I'm going to be my best self when it comes to my taxes. What's the best thing that we could do now to make the process smoother for next year?
Ooh, I'd say get on top of your organisation and documentation of everything.
100%. You should be doing that throughout the year. And if you're not doing that throughout the year, getting it done now, like now is always the best time to do something, now in the moment. And getting on top of your documentation, collecting all your receipts, having an understanding whether it's in software or on a spreadsheet. What is all your income? Where is all your income coming from? Because you can have multiple streams of income. You can have a job, you can have a side hustle, you can have a property, you could have some stocks and shares, you could have some interest you receive from the bank. There is so much variety of income, and bringing that all into one place and getting clear on everything that you've got coming in. But same as everything you're going out with that side hustle, what softwares have you paid for? What insurances have you paid for? Do you have to rent an office? Do you have there's so much other stuff that you could literally claim back. Have you done some entertaining? Have you taken your staff out for lunch? Have you paid wages? Like all of these things, like subcontractors, anything like that. Collect it, collect the invoice, collect the receipt, and keep it. Worst case, if you don't, not storing it in like a safe or a shoebox or somewhere, or your purse. Honestly, the receipts that I've seen, like you know the clowns that pull out the scarves and it just doesn't stop. Like I've seen that with receipts out of purses. My biggest tip to stay on top of your organisation is 1, get an accounting software. Get an accounting software. There are plenty on the market. Choose one that suits you for your business at the stage that it's at. The second thing is to get a document capture system that integrates into the accounting software. So that document capture system is basically just a camera that's stored, like you can take photos and it stores the files. But because it links into your accounting software, you know everything is kept. So when it comes to doing your tax return, there is no last minute scramble of trying to find all these receipts, because the likelihood of you throwing something away is high. The likelihood of the ink coming off the receipt is high. The likelihood of you deleting an email that has a invoice in it is high. So getting it all into that software when you've received it, when you've paid for the goods, when you've paid for the service, is absolutely crucial to good financial management and being really, really well organised with your finances. Honestly, it's a game changer.
One of the things I used to do in the past is leave everything to the last minute, and then my accountant's like, hi, can I see everything? And then I have like hypertension for 3 days.
It's like the anxiety of that phone call. So like,
do you not think it's crazy that a financial advisor that's giving this advice, saying stay on top of your documentation, in the next breath is then going, yeah, but I do the same thing? It's crazy. Like, practice what you preach. There's nothing worse than that ball of anxiety you feel when you see your accountant that only reaches out to you when you're doing your tax return and it's like, where's all your receipts? No, it's not fun. Stay ahead of the game, because you can just honestly just completely get rid of that anxiety and that stressful feeling.
Receipts, have you done the thing?
Yeah.
No.
And it feels like school, because like, what's this for? What's that for? What's this for? And you're like, this is for that, that's for that.
Yes.
However, once you stay on top of things, week by week, month by month. So for example, if you get income coming in, the company should usually send you like a remittance advice slip. Mm-hmm. And what you can do with that is essentially just keep it. So I'm with Starling Bank and I attach everything to that transaction. So money comes in and I'm like, okay, great. Here's all the documentation that shows and proves I've worked with this company. Or if I have an expense, I'm like, great, here's the receipt that shows that. The key is...
That is also a really good other way to stay on top of it, especially these modern day banks like your Monzo, Starling, Metal. All of them banks do offer that where you can link it in. The only problem is 9 times out of 10 when you do something like that and you link it into your bank account, if you are using a separate accounting software, it doesn't integrate, which is why I always recommend, if you are a small business, self-employed, or even a limited company, use a document capture system.
On top of that, as often as possible, don't wait till the end, because it can give you more calm, if you will, as opposed to just wait until the end. And also, maybe halfway through the tax year, speak to your accountant and just ask, like, hi, where am I? What are things looking like? It's okay to have that conversation. And I think a lot of people don't know that. Yeah.
Because it's probably that conversation we all put off.
Yeah.
Because also, like, if your accountant's going to call you or you need to, it's always for something like this that feels like the thing that you're going to put off until you have to.
It feels like they're stealing your joy.
It does.
Like you're going to have an amount, they're going to go, no, it's double that. And you're going to be like, going to go cry now.
And that is why it's so important to actually have that conversation with accountants through the year and to touch base with them. And it's not the accountant's job to tell you, it's your responsibility for your own tax. And it's your responsibility to make sure that you've got all of your stuff together and either staying up to date with it, keeping it in a separate software that you can maintain. That the software's out there that feed you an estimation of your tax. So having that is perfect. But it is down to you, and it's not down to the accountant all the time to be like, this is what your tax is, this is what your tax is. There is definitely a meet in the middle with that for sure.
We'll talk about it. It's like, oh, I've got to do this for the tax man. I mean, I don't even know who the elusive man or woman is, but we'll say he's a man. And it does fill us with that dread. So are there like apps and places that kind of simplify that for us? So we're in such a modern world that everything's online, everything's tech.
Yeah.
The idea of like saving a receipt seems quite archaic now, and I know it is.
You know what's crazy is you don't actually have to just have that document capture software that I've mentioned. You could literally just take a photo of the receipt on your phone. I have an iPhone, and if I took a receipt literally on my normal camera and then I went into my photos and searched for receipt, it will pull up all my receipts. There is literally like zero excuse as to why we lose receipts.
But it doesn't kind of, in this like making life more convenient era that we're in, which we love.
We love it.
Holding on to a paper receipt is counterproductive.
Yeah, and you could easily lose it. So with some apps, you can add attachment and then you can add your receipt, just take a picture of it. However, there are apps like OneTap. Because I have like an Amex business card, I can't do that in the Amex app, I don't believe. So I use OneTap and take a picture of those receipts and add it there. There's also like Dext. So there's a few services, QuickBooks and things like that, where you can, and Xero, where you can kind of attach things directly.
You know what's frustrating me a little bit about this video is she's not an accountant. These are not answers that really she should know. She's doing a great job at replying to them, but it also screams at the lack of understanding from Rochelle and the interview herself, is that she doesn't even know the difference, and she's asking all, like, as a 5-6 minutes into this video, to have this conversation with her that isn't actually what she does, screams to me that there is just such a lack of understanding around the difference of the two. Like this, well, she's, as I said, Bola's doing a great job actually explaining some of the stuff. Like, as a financial professional herself, she's definitely going to have picked up these tips and tricks, but she's not an accountant. So she was not going to be the one that can advise really on Xero or advise on QuickBooks. Like, she's given great answers, but it just screams that you don't know.
It syncs for you, because you don't want to do that heavy lifting on your own.
No.
You want to feel like, okay, this is sorted, I don't have to think about that. So wherever possible, I do think that there's things that you can allow it to like sync across, and those are some of the apps that help.
Okay, that's interesting. let's talk about launching a business, because obviously the tax thing, like you say, we've got to all get better at the preparation, and you know it's timely because that's where we are now. But the whole kind of ethos of this podcast is launching, right? And ladies looking to launch, have launched, the stories about the journey across the way. When it comes to finances and I suppose someone looking to launch a business right now, what do you think are some of the most important first steps when it comes to finances that they could kind of start with on day one before? Because when you are launching a business, the initial, without investment, which we know is
hard,
is very hard for women. We discuss the gap a lot, and the 2% number that flies around is actually way too stark. It can be hand to mouth at the start. It's very kind of, unless you've been conscious and you've thought, I'm going to do this extra job to save that pool of money to execute this idea, it is hand to mouth at the start. What would be your kind of like steps that they could take from day one?
I'd say from day one, ask yourself if you want to be a sole trader or if you want to set up a limited company. And the reason that's so important is because you have to think about limited liability. So let's say, for example, you choose being a sole trader and maybe you have corporation tax, maybe it's higher than you thought. You are
This is what I mean, where she's not asking the right questions to the right professional. These are questions where she should be posing it to an accountant, because choosing being a sole trader and maybe you have corporation tax. If you are a sole trader, you don't have corporation tax. You don't. You have personal income tax. You are liable for income tax. So while her answer is great, I definitely think that one of the first things you need to understand is whether you want to be a sole trader or a limited company. Both of them have different obligations in terms of compliance to HMRC. But it's not even so much just that, it's what do you want out of your business? If you are wanting to grow, scale, and you know you've got big visions and you know you want this to be a massive thing, then I would always recommend setting up straight away as a limited company. Because if you've got the foundation that you want to build on and you've got the idea that you want to execute and you're ready to go, you've got the money that you can put into it, then great. I actually set up Gingerbook straight away as a limited company because I knew where I wanted to go with the business when I founded it and what I wanted out of it, and I knew I had big goals. So the things that you've got to think of when you are a sole trader or a limited company is, one, the limited liability. If you are a limited company, you have got a type of protection against you if anything was to happen, whether the company went under or whether it got sued. There is that limitation and separation between you as director and shareholder and the business to an extent. As a sole trader, you are acting as you. You are you. That is a massive misconception that happens within the two different structures, whereas a sole trader, you are you, whereas a limited company, you aren't you. You are running it. It is it in its own right, its own entity, and you hold the shares that run that company. It's different. And there is also differences with the tax. As a sole trader, you get taxed on normal self-employed taxation rules, which is the normal banding of 20, 40, 45% of tax. As a limited company, if you've got, it depends on your profits, I'm not going to bore you with all of that, but up to £50,000 is 19%. And then that's profit. If it's £250,000 in profit and above, it's 25%. And it's the sort of sliding scale between the both of them, between the two figures. So it's understanding what you want out of the business. Is this a side hustle? Is it something that is only going to be generating a couple of £100 a month that isn't great a scale? And that's how you want it to be. You know you've got a 3-year or 5-year plan to exit out. That is usually the better option to set up, because you do have additional accountancy costs that comes with it, because the compliance element is only a self-assessment tax return when you're a sole trader. That is going to be changing in the next year, actually, by 2026. There is other obligations that are coming in under the Making Tax Digital regime that HMRC have brought in. But as a limited company, you have to file a set of annual accounts to Companies House. This is all based in the UK, by the way. You have to file a set of annual accounts to Companies House, and you also have to send off a corporation tax return to HMRC for the tax that is liable on the company. And if you have taken out anything in dividends, which is not a salary, it's the money of the profit that you take out, you get taxed on that. Whereas if you're a sole trader and you take money and you draw in that money you don't get taxed on, because you get taxed on what your profit is through the whole thing. Like, that money is yours because you are you. But as a limited company, any money that you withdraw out is dividends. So basically, you end up have to do more tax and compliance obligations as a limited company as to what you do as a sole trader, which obviously has a monetary cost. Inflation from an accounting point of view, an accountant charges more for limited companies, so there is that to think of as well. But yeah, I just wanted to go on about that a little bit.
And maybe you have corporation tax, maybe it's higher than you thought. You are personally liable for that, whereas having a company limited liability, it essentially kind of means you're very separate from your company. So it's two different entities. But once you're a sole trader, let's say you decide you don't want to set that up, then you always have to attach it to everything you've built personally.
Yes, so you are, by setting up a limited company, you are adding a layer of protection to yourself and your assets.
Exactly, and separating like you from your business just in a legal format, whereas like you and your business are a lot closer if you're a sole trader, if that makes sense.
You are the
business.
business.
You know what's so interesting? Because of I was telling you before how I actually am, for somebody that runs businesses, has businesses, I am, the finances and that part of my brain is something that I've really struggled to tap into. I've become very conscious of it, and you know, I know how to stick to a budget, or whether that happens or not. But I am quite incompetent when it comes to that. And I remember at the time, I'm fortunate enough to have an accountant who's great and who advises me.
Yeah.
However, I remember when I launched my business, that I'm saying, no, this is mine. I want everybody to know this is my baby and I'm doing it myself and this is my business. And him really educating me on, okay, but when something happens, because I'm not saying it will, but if it did, the liability is on you. So and I really didn't understand. I found that I don't know why, I found that really hard to process. I'm like, no, I don't get it. But actually having that layer of protection is so, so important.
Yeah, because it just means that whatever happens in your life, especially, you're a family woman, it's just so different for you. Like, you don't actually want it to interfere with your personal life in that way. You want to love your business, but love it from afar.
Yes, yeah. It's really, really good advice, and something that I think the quicker you get your head around that, the better, you say at the start.
Yeah, and also opening a business bank account. So, for example, I think sometimes even bookkeeping can become incredibly messy if you are jumping between your personal and business account.
Yes.
Or you're saying, oh no, I've got some work expenses here, and you've taken it from your personal account, and then bookkeeping is now in two different places and so on. And I just think it's so important that people separate that as soon as possible, because some people don't, and then it's
as soon as you register your company, whether it's a limited company or you registering for sole trader, and you are taking that decision, the first thing you should do is look for a business bank account, and that is where all your money, business related, lands and goes out. Simple as that. It causes so many problems and mismatch of stuff, because you could be scrolling through your bank statement for literally hours going, think that's business, don't know, think that is, don't know, and it gets, as she said, super messy. So that I really agree with.
For anyone who is looking over your accounts in the months to come, for example, in the future.
And I think that is one thing that is really hard with small businesses when they start. I've got a friend very close to me that actually, she makes clothes and she's got a beautiful brand, but she didn't expect the growth to be as quick. So so fulfilling things like orders and, that's one side of it. But actually, I was sat down with her, which is kind of laughable that it was me that was doing that. But now I feel like I've got an experience, and I've got that experience behind me. But sitting down and saying, okay, so this product here, that first run of dresses, how much did that cost you?
Yeah.
But when it's it was exactly that, so hand to mouth, that we couldn't then, it was so hard to track what she'd spent on, you know, to bring certain things to market, because it was so much in the personal.
Yeah, it could even be something like, oh, she's done so many parts of it through her business, and then she's gone to post it and she spent money on her personal account. It's the small things like that. And I used to do that, and I'd be like, oh, it's only £4 in the post office. But then it starts to add up, and then once you end up paying tax, you're like, what difference could that £4?
Yeah, no, of course.
It ends up,
of course.
yeah. So you just have to be accountable for yourself as well, because you want to keep your money. And every time you kind of put things down personally, sometimes you can even forget to add it up, and I've done that in the past, and that's when I stopped, because I was just like, you are missing out on tax deductibles because you're not separating this properly, so just don't do it anymore.
Yeah, and I think it's, which again comes back to that sort of self-discipline.
Yeah.
So you really kind of like those odd, meeting a client or going for a coffee, those odd things that are like, it's £10, it's £4, it doesn't seem like a lot at the start.
Yeah.
Are always going to amount.
Yeah, sometimes I meet with meet with friends, and it could be like a business meeting, and I'm literally hovering over like the contact list for a second, and they're like, are you okay? And I'm like, is this a personal, is this a business? And I'm like, this is a business meeting. And I'm like, all right, tap this card.
Yes.
Because you're constantly chopping and changing, where am I, what am I doing, what is this for, and so on.
And it's so kind of, when you, like you say, when you live life like that, it is so easy to just be like, oh, it's just a coffee, and you're on to the next thing.
Yeah.
But actually, the hovering over the contact list is very smart.
It's so important.
Takes a second,
but it's so key, because I'd rather do that and hover for like a couple seconds than have to go back later, and my accountant's like, is that all your expenses? And I'm like, oh no, wait, this time I had some coffees on here, let me go to that, and go to that account as well.
And I think when you're looking at like keeping your accounts in one place for any future possible investment, or kind of people looking to help you or prop up the cash flow, everybody needs a clear sort of.
Well, this conversation completely relevant, and it does help with tax deductibles. It also helps with trends. It helps spot your spending habits and going, well, what am I spending my money on? When am I spending it? And then you can dig deeper into that and go, well, why have I gone through and splashed £30 on coffees in a week? And it could be because you are connecting with friends, or it could be because you are out more. But looking into compulsive and impulsive buying, I think, is really important. And that's having your money in one area and going in and out shows the trend of how you spend. Like that. Shows the trend of how you spend. So it's really important to keep it in one place.
Side of everything.
Yeah.
What do you think would be one of the biggest sort of financial mistakes people make when starting out a business?
Yeah, I would say not thinking about the accountant they choose. I have friends who have Googled accountancy services and picked the top one, which there's nothing wrong with that, but I also think it's good to have reviews and know your why, and know your why may be very, very different from someone else's. So if I was starting a clothes brand, I might speak to people I know.
I think it's important when you are looking for an accountant to look at the type of accountant that you want to be handling with, because it's very easy to tar us all with the same brush, but I am very different to the accountant next to me and the accountant to my right, sort of thing, and whoever's above me or below me in a Google search. For me, it's understanding, well, what is it you want? Do you need that hand holding? Do you need somebody to be like, this is what you need to do and how to do it, and I'm going to guide you through the steps on how to do that, and be there as your financial accountable partner, which is basically how my practice runs. I have like 5 stages of packages which layer onto every area of business that you go through, as you go through, like from startup to grow to scale. And it's sole trader, limited company, like VAT, and then like you need your reporting, you need a bit of this and a bit of that, and it scales all the way up to basically having a fractional CEO, like CFO within the business. There are accountants out there like that, and it comes from having them conversations with the accountants, and also recommendations. Going to people that you know that have businesses and hearing the recommendations of them, but not just jumping feet first into the first accountant call that you have. It's Know what accountant that you want out. There are a lot of accountants out there that are very transactional, that will just be like, here's a tax return, this is what I do for you, and I touch base with you once a year, and that is cool too. And it comes from knowing what is it that you need and you want from that relationship too. What are your expectations?
Have closed brands already and ask, hey, who's your accountant, because of the type of business it is, versus maybe somebody who has a service-based business. And I also think that people need to think
niche is important as well. Understanding where the accountant's niche is. Not every accountant has a niche, but if you're an e-commerce business, there are some great accountants out there that deal just only with e-commerce, and then you've got other accountants that are service-based. You've got other accountants that are construction only. Like, it's about finding the accountant and the bookkeeper. If the accountant doesn't do the bookkeeping for you, finding them both that pairs really well into your niche, that understands your business, your pain points, and what obligations you need to be adhering to.
How often is your accountant communicating with you? Because what happens is, when I've had the best accountants, it's the ones that are constantly keeping me on top of things. The worst accountant I've had is the one where it's like, I'm messaging him and I'm like, hi, is everything okay? Because you don't know what's going on. And I know a lot of people who their accountants have really messed them up financially. So as a result, they're like, oh my gosh, this money's not mine. I have to give more of it because they didn't tell me about this and they didn't tell me about that.
Yes.
And, you know, you can feel like, oh, great, I made this much profit. And then maybe you get someone else to check your money and they're like, actually, you didn't. You need to take more out. Or did you consider this and did you consider that? So I think it's just key that people don't just think, oh, let's just go.
I think that's the importance of having the meetings throughout the year, like when I was mentioning about looking at your tax return, but having them conversations with your accountant throughout the year so you know exactly what is going on, rather than just letting it tick over, turning a blind eye and burying your head into the sand, to actually take that responsibility and go, is this accountant right for me? Am I having these type of conversations? Is my accountant telling me what my tax bill estimate is? Have I got enough saved for my tax bill estimate? Am I putting enough money aside? It's so common. It's so common.
Accountant, or that works for you. You have to make sure it works for you. You're happy with the communication? Do you feel like everything is above board? Because sometimes I have heard a lot of accountants don't have good communication.
Yeah, and I think that comes down to everything, doesn't it? We see that so much in business, that communication is key. And so if it isn't there, whether that's a supplier, whether that's an accountant, whether that is, you know, it's always going to sort of cause tension across a relationship, isn't it? It's so interesting you talk about having an accountant, because when you're budgeting and you say, like, you have saved up a pot of money that you're going to take this venture and you've got this product that you want to bring to market. What is interesting is I don't think people actually account for an accountant in that budget.
That's true.
So I think maybe that's also a mind.
And if you're wondering what that should be, you're going, shit, I don't do that either. What should I be factoring in for an accountant? If you're making £100,000 in sales a year, you should be allocating 2 to 3% of your money needs to go to that accountant. So 2 to 3 grand, pretty solid. Like, it's quite easy to manage.
Set shift, because we look at, okay, how do we bring this here? It's
just to add it in as well, accountant fees are completely tax deductible too, so that comes straight off your tax bill.
An accountant is thought of later on, right? Yeah. So, like, I think, which is fair, because when you're starting, you don't have the finances to have a team. Or would you we talk about spending money in marketing, we talk about the web developer, we talk about putting money in different places, but would you really prioritise an accountant from the jump in that initial budget?
No, not from the jump. Maybe after the first 6 to 9 months, I'd then start shopping around for an accountant and things like that.
Right,
but,
okay.
This is interesting. I'm going to disagree with her. The reason being is I've had so many people come to me and going, okay, we've been in business 6 months, a year. Yeah, cash is a little bit tight, and I'm not saying that it's ethical for an accountant to make sure that they're selling, because we are selling as well. We're selling our services. We need to make sure that ethically we're hitting that right point. But it's so much more refreshing to know that you've got somebody there as that support partner, that if you have got any questions that you can relay back to and going, have I set up my taxes right? Have I got the right bank account? Am I keeping my receipts? Setting you up on a software from the get-go, so it's, you know exactly how you're managing your money. I really disagree with that. I have taken on people that are literally in a couple weeks in and they're going not too sure, and they've gone with me and they've gone, it's the best thing I could have done. Like, I really set myself up on the right path straight away, because you don't want to be firefighting with your business, especially when it comes to your finances, because it could be detrimental in so many ways. Because obviously we know the stats that, is it what, 3 in 5 businesses don't survive past the first 4 years. Imagine if you could actually survive that and have somebody looking after your money with you, especially if you're a little bit like Rochelle, that feels a little bit like undereducated, incompetent. If you are feeling incompetent and uneducated, why would you continue to do it and not seek help? That's my reason, because it's not like it's a small thing. It's not like it's a website. Anybody can go and download Wix and build a website, but it's very rare that people know what to do with their money properly.
Why do you say that?
Because you don't need an accountant straight away once you start a business and so on. So it's really important that you give it a second, essentially, because there's nothing to report yet.
Yes.
So it's just about
it's not a case about there's nothing to report yet. It's about setting you up so when you are beginning to report, that you know exactly is what you need to do. So have you got the right softwares? Are you taking receipts, like photos of your receipts? Because she just gave loads of really good tips, but if what you don't know, and if you're not having them conversations with an accountant from the jump and going, what do I need to be doing to make sure that I am financially secure, enabled and free? What should I be doing from now that is going to set me up with a really good future, so in 12 months time I'm looking back and thanking myself? Then it needs to be straight away.
Until that period.
Okay, fine. So the first sort of 6 to 9 months, and then see how that looks. So in those first 6 to 9 months, what would you say, apart from the organisation and having everything streamlined, which I think is such a valuable piece of advice, that actually you should you should look to have a business account initially. What would your kind of must-haves be to start a business without an accountant, without maybe a financial background or expertise? What would you say should be the kind of do's and don'ts?
Make sure you have an emergency fund. So within your business, like 3 to 6 months of expenses, even if that includes maybe paying yourself, because I know some people...
It should definitely include paying yourself. That is an expense to the business to pay you. You should have enough money where you know that you can pay yourself for 6 months and your expenses on top, so you are not left in the lurch financially on a personal level as well.
They're bootstrapping, they're doing it alongside having a day job. But some people, they're like, I'm going all in and stuff like that. And people can have really exciting months where they're like, oh my gosh, I made this much money. And what I find happens to people psychologically is they start thinking that they're going to make that same amount of money every single month.
Yes.
So then they're like, oh my gosh, I made 20k this month. And then maybe another month they make 35k. But then the economy can change. So many things can change. And they're like, where is this money gone? So when that money does come and it does do well, just start putting some money away for some basic expenses for your business. Again, if that includes salary for yourself, because if you do hit hard times, you don't want to feel like you didn't prepare for that, and maybe you were reinvesting so much into the business that you didn't think about how the business would survive.
Yes.
In times of...
Something that gets like hugely confused and a massive misconception is the difference between profit and cash flow. So people can have these 20, 35k months and they go, oh my God, I'm making thousands in profit, but they look at their bank account and they have nothing in relation to it. And I'm sure many business owners can relate to that, and they think, where's my money gone? But it's because what is on your profit and loss isn't the same as what's on your balance sheet. You have 2 financial statements that you need to be looking at, and the money that's coming in and out of your bank account sits on your balance sheet. So if you've got loans, if you've got liabilities, if you've got big wages, you've got to pay, if you've got multiple staff, their PAYE that you pay over to HMRC, because if you imagine when you were an employee, or if you are an employee yourself, you know, you get your pay slip come through, you know you're on a 30 grand salary, and you get your tax taken off, and then you get your tax taken off and your national insurance and your pension taken off, and then you're paid what's left. From a business point of view, you have to pay that PAYE that you've taken off them to HMRC. So there's that cost in there as well. You have to pay their national insurance over, their pension contributions over, as well as your own. And their stuff doesn't sit on your P&L. It sits on your balance sheet. So that's where a massive confusion comes in.
Change.
Yeah, okay, emergency fund.
Yeah. It's emergency fund, yeah. I've had people argue with me about that. But luckily accountants came to my defence, because I said once that if you're an entrepreneur, maybe you're making over £15,000 a month. And I said that because we're in the age of influencers and content creators. People are making a lot of money.
Well, you're talking hypothetically too, right?
And some people were like, oh, that's not a good idea to have an emergency fund. And accountants were like, everyone needs an emergency fund. I know of someone who runs a hedge fund, and they're like in their 50s, and they didn't have an emergency fund. Everybody needs one, because if something does happen, you want to have that buffer.
Well, nobody knows what's...
The best example to give to this is COVID. Nobody expected COVID to happen. It shut down so many businesses because they didn't have that emergency fund. That, yes, we didn't realise that COVID was going to go on for as long as it did. So we didn't realise that salons and restaurants and stuff like that would be closed for such a long period of time, because it was like 2 years until salons could properly open up and start serving the public again. But they still have rent to pay, they still had their wages to pay, they still had furlough to pay, and that's the reason why loads of businesses crippled and ended up shutting down during COVID. Equally, like, you've got the boom that happened with online businesses, but brick and mortar businesses didn't have that emergency fund. You don't know what is around the corner, you don't know what the economy is going to shift, or what pandemic is around, or what war could happen that could set your business back. But having that emergency fund means that you can survive for 3 to 6 months, and it gives you that buffer to put a plan in place, to pivot your business, to find another strategy without thinking that the world and that your business and your life is going to literally come crumbling down and come to an end.
On it in life, right? I think it's never... If you can afford every outgoing and every, thing that you need to make your life operate... and you've got the luxury of having an emergency fund, it's like, why wouldn't you?
Literally that. And it just feels so much better. There's been times... I think the pandemic is a fantastic example.
Yes.
Do you know what I mean? I
There we go.
think we saw so many news reports where it's like companies don't have 3 months of cash flow, and maybe they were operating on...
And that's when the bounce back loans come into play, and there are still people now having to repay that bounce back loan because they wanted to stay afloat. And yeah, it was great. It gave us a little bit of extra money to be able to use and to survive. But people are still paying that off now. And again, that's not shit. That's like 5 years down the line. That's 5 accounting periods of past. It's 5 profit and loss reports that have been performed that you could be making profit and profit and profit and profit every single year. But you're having to pay out X amount on a bounce back loan, which again is on your balance sheet. And that's the things that people don't take into consideration.
Fall depending on the type of business, and then that's when you want to say, oh, we've got some reserves and stuff like that. So
Okay, emergency fund always. We touched on apps before, and how there's a lot of ways now to simplify things, to make it easy, to make it convenient, to kind of move smart with your money. What are some more kind of simple habits, hacks that people can implement today to keep better track of their money?
So first one, I'd say no matter what, just take a picture of a receipt, and if you just have a folder, just keep it there, because if anything does happen, you just want to say that you actually have a copy of that somewhere, because at times we don't go into the app on time. So I'd definitely say that's one.
One thing that I would say is, if it is in person and you're at a coffee shop, getting a coffee, at a dinner, buying client at a business meeting, some dinner or something like that, Definitely always take a photo of it on your phone, but best practice to get into is open up your app then and there. Then as you are stood in the queue, you've got the receipt in your hand, take a photo of it and ping it over straight away. But do take a photo of it on your phone too. I think a folder is a great idea to store it all in, but I know some people don't like working off of folders in their photos. So as I said, if you literally like type in receipts into your photos, it's so easy to do. Let me just show you. If you type in receipts, you're going to see all the receipts show up in your phone. They're all there. They're stored. So you don't necessarily have to keep them in a folder because there are ways to find them. But I definitely agree with her that you need to take the photos as you go. And another thing is, obviously we have some that get stored in our emails that, like Canva, for example, automatically send the invoice out to your email. Setting up recurring rules in there. Most of these document capture systems that are in play have a unique email address that you can forward on the email to, and if it's got an attachment in it, it will automatically extract that attachment as a PDF, as a document, and that's what lands in your document capture system. So auto forwarding, setting up rules in your inbox that automates it, streamlines it, and takes the time. Yeah, it's a little bit of time on the front end of it and making sure that it's all done. You can even set a rule up to say if it says invoice, you can send it straight over. So you're not even having to do it on each contact. You can do it as a blanket for invoice.
Just have your own like filing system. Although a lot of these apps are supposed to work, sometimes they don't, or they have like a 90-day period where they will connect and then you have to reconnect.
Right.
So maybe if you've got an email and you're not up to date and you don't have the reminders, you might think, oh yeah, it's tracking everything, and it's not. So I'd always say maybe have a manual backup as well, just in case. And you don't.
That only really applies if you're using accounting software and you have bank feeds. So bank feeds are open banking that links your bank account into the software and it pulls through the transactions. That is typically a 90-day thing. But in terms of the document capture system, as long as it's integrated into your accounting solution, there's generally no issues.
Think about it too much. It's just, add it to this file, or just take a picture of the receipt and just do that. That way you're just up to date. You don't have to think about everything now, but it takes some of the pain away.
Yeah, exactly. It's always sort of keeping your own records and not as much as good as the apps are, not relying on technology.
Yeah, because I've done that sometimes and I'm like, would you mean it stopped syncing?
It can't.
Literally.
Is there one financial habit that you swear by that we should be doing, that we get so caught up in the day-to-day outgoings and then you're on to the next month, and then saving for obvious things that, you know, might be something that feels important to you in your lifestyle, like let's get to this moment and then we can have a holiday, or that I think that we then don't think bigger picture.
Yeah, definitely. So I'd say saving and investing, I make sure that that's something I do every single month. And I think it's easy to save for like an emergency fund, even those 3 to 6 months of expenses, and you want to buy a home or you want to go on holiday, sure. But also investing. Now, something that's really important for people to know is that because of inflation, we need to keep inflation to 2%, right? So that's like the base rate, and that's what the Bank of England does. They try to keep inflation to 2%. If you're getting 5% on your savings, the real rate of return is 3% because it's 5 minus 2. If savings rates now go down to 1% and inflation is 2, you're not really making any money. And that's why I tell people that you need to push past saving alone. You need to invest. And that's the whole point, that you are getting a higher return. Let's say it's 7% or 10% if you invest in like index funds, which is a pool of different companies, for example, or exchange traded funds, which is, again, is a pool of different companies. Then the hope is maybe on average, if you return 10 or 11% and inflation's 2%, you still got 9 in a year that you've made. Whereas savings can't always compete with that. So I always say it's so important that like you allow your money to work hard for you, and also let it compound, because if you put away a certain amount of money and then you invest more and more and just add it up, that becomes more money on top and it compounds. And then one day you look back and you're like, okay, great, I'm in a good position now, and maybe I'm going to add more. Some people withdraw it for reasons. When I bought my first property, I I think I took a heap out of my stocks and shares ISA of like investing, and that's because it compounded and I left it in there for a few years. So I just say like, yeah, I swear by saving and investing.
Okay, I like that. And it's like you say, like,
It definitely has a part, like each in its own right has a really good reason as to do it. There again, what she said at the very beginning of the video, when she works with a client, she has to work out their attitude to risk, and that really depends on whether you are more of a, not so much an investor. You can still invest, but invest in low level risk portfolios. But saving, as she mentioned, like with a 3 to 6 months worth of expenses, that shouldn't just be for business, that should be for yourself as well. What I recommend to do with all of my clients is, especially if you are running a business, is to automate your savings. So a lot of the bank accounts now have pots facilities. So Metal, Monzo, I use Metal myself, and what I have done in Metal is every time I get money come in, I have 15% goes to my tax pot. So I'm already putting 15% aside, and I know that tax is a little bit higher, but from being tax strategic and efficient, I know that I'm claiming back all of my expenses that I can claim back, and I know that I am maximizing other operations in being tax efficient. So that's the reason why I always say 15%. And the same goes for VAT, because you can net off the things. So when you are charging VAT, that's cool, like that's the VAT that you have to pay over to HMRC. But when you are spending on stuff, especially with VAT registered businesses, you're paying VAT as well, and that can net off. It's the same with tax, like you offset it against the other one. So I say I automate 15% of my income goes to my tax pot, 15% of my income goes to my VAT pot, and then I have 30% that goes to my owner's pay pot. So I know that I can pay myself. I say it's owner's pay, was called owner's pay, but now I'm building out a team, it's called wages. So it's all relevant. But I have like, I know I want to buy like a new camera and new stuff like this, so I have an equipment pot as well to my 3 to 6 months worth of savings that I've already got stored. So yeah, there's loads of ways that you can make it work for you, whereas one thing I always do recommend is having like a money date on a monthly basis with yourself, sitting down and actually having a look through all of your business numbers, understanding what you brought in, what have you spent, is it more than what you spent last month, why have you spent more than last month, have you had a higher revenue month, what drove that, was it a campaign you had on, and really understanding as why, what went well, what went different, but having that end goal in mind to go, if it's a mortgage you're saving for on a personal basis, how much is it that you need to have saved? How long is it that you want to be saving for? And how much does that mean that you need to save per month? Reverse engineering it. As I said, investing is brilliant. And you've got different areas, like ISAs are very low level risk. But then once you go into like, it depends what ISA it is, whether it's cash or stocks and shares. But it's about mitigating it and making sure that you're not throwing all of your money into investing and not all of your money into saving, and you are splitting it out in a way that's comfortable for you and that works for you and your goals. Because it also depends on the accessibility of it. Like, you can't just always pull money out there and then when it's in investments and stored other places. Like, it takes a little bit of time to pull out. But if it is in a savings pot and that you've already got it saved in your own bank account, albeit it won't be the most highest interest rate you're returning back on it, but it's easily accessible. So it's about understanding, well, what is it that you can afford not to have compounding interest on, and what is it that you can?
Smarter, not harder.
Yeah. Especially in the future, sometimes I always think about, what do I want to be doing in 30 years? Where do I want to be? And what will my money look like? And essentially, what do I need to do now to make sure my money looks good then? And that's when I'm like, you've got to work smarter. You don't want to feel like the only time you're making money is when you're working hard for it or when you're present somewhere. And that's the whole point of investing. Now, of course, that's traditional investing. You can invest through businesses, of course, like that. And, but it's just so important that you think, how can my money grow without me constantly having to like watch it and stuff?
Yeah. And how about things like, I just remember my nan being obsessed with premium bonds.
Oh yeah,
like that was like a thing. She's like, another premium bond.
Yeah.
Is that still a thing?
Yes.
ISA still a thing? Like, do they still? Is that still smart?
Yeah. Premium bonds are great, and of course you've got the NS&I that people can go on. I forget what it stands for, but you can invest in premium bonds that way. And there's like a lottery service, which essentially means that you invest a certain amount of money and then you have a chance of winning a little bit of extra to go towards it. But people still invest in premium bonds just for the sake of diversity. Like, some people don't want to be like, oh, all my money's in one thing, so they spread it across different ways. And bonds are very risk averse assets in comparison to other things where you know, your capital's always at risk when it comes to investing, but premium bonds are deemed as quite safe, and then you know you're getting your money back.
If we're looking to save or invest, however that would look, when it comes to somebody's outgoings and knowing what portion you can save, because I think that's another thing too. Like, savings are well and good, as I said before. Like, if you're privileged enough to be able to get by, survive, do what you need to do every month, and you've got money left over to save, how should that look? Is there like if we're looking at kind of like a ratio of what we should be spending and how we should be living in kind of like beyond our means, you know?
Yeah, so there's like a well-known budgeting rule, which is like 50-30-20, which is 50% on your needs, the things that you have to like put towards everyday expenses, mortgage, rent, whatever it is, and all the utilities that come with that, and 30% on your wants. You want to go out with your friends, whatever it is, and so on. And 20% is supposed to be on like savings and investments and stuff. So people always ask, how much should I be putting away? And I say, you know, roughly around 20%. However, if you can put away more because you're in a position to do so, do it. But if not, try to hit that minimum, because it's so important that we all live beyond, live beneath our means. You know, and I know that costs are going up in different places, so it does mean that you are having to change that buffer, but it is incredibly key that you actually have enough to save from time to time, as opposed to, oh, my money doesn't stretch that far enough, because when the future comes, the future's going to knock and it's like, hello, did you not take care of me? And you just want to make sure that you've actually been putting money away.
It's quite interesting. I've not heard that 50-30-20 rule before, because it's almost working backward.
It's one of the biggest accounting, budgeting ways to go about budgeting, in all honesty. So your 50 is like your must-haves, and it can be applied to business finances and personal finances as well. But if we're talking business, your 50% are your wages. You know you're going to have to pay out your staff. It's your rent, it's your insurance, your licenses, like anything that goes into your software, the things that you know you need in order to work. But just because they're a necessity doesn't mean that you can't cut them. I think that's really important. That 50 shouldn't just constantly grow. It should still be monitored to make sure that you aren't overspending within that necessity, especially on things like energy and utilities and stuff like that. I want to make sure that you're always getting the best rates that you can. 30% is for, like, as you say, all of your wants. So it's the things that make you feel good. It's the things that you enjoy doing. It's the holidays. It's things like that you want to go and do. And then 20% should be your savings and your investments. And it's entirely up to you how you want to split that 20% out between the two of them. Always say, make sure you've got your base of savings from that 20% out first. So at least then you know you've got your savings. You can definitely, I wouldn't say it's always one. It's not just, if you're taking 20%, you're putting it straight into your savings straight away. It's not like that. You can invest small and get to know the market, get to begin getting comfortable with investing, because it can be quite intimidating, especially when you don't know what you're doing to start off with. So just like a little bit of money into that investment pot that you can see to start compound, and then it gives you that, so not enthusiasm, but that motivation, and that, like, okay, this is working, let's keep going. And then eventually your savings will be where you sort of want it to be. There's no harm in still increasing that, but the split can then change. So instead of it being like 15% saving, 5% investing, it can then become like a 10-on-10 split, or a 15-and-5 split, depending on how you want to do it. I think this is the important thing. Like, it's not linear, and it is dependent on everybody, but this is just a framework to work off, and there is ways to make that framework work for you.
Isn't it? And we all kind of, like you say, the idea is not to live beyond your means is to live beneath them.
Yeah.
And actually, if you look at your income, what you do with that 50% should slot into that, as in like what the outgoings are.
Yeah.
The house that you rent, that you know that that's how it should figure itself out.
Yeah, and that 50% rule, even on your needs, is a great indication of where you're at and what you're spending on. You know, that's where they've got this affordability kind of preference when it comes to homes and buying. They want to make sure that you can afford it, because back in the day, I think like 20 or 30 years ago, someone on like 30 or 40k could buy like a 1.5 million house, which is insane when you think about it, which is why they now have the multiplier of 4.5 times of your income.
Right.
So for example, if you're on 100k and you want a house that's 500k, then you can probably afford it after you pay the deposit for the house. And so that makes sense. Whereas back in the day, there wasn't a multiplier, so people could go wild. They were defaulting on their homes and losing their homes as a result. So it is key that you look at, okay, how much of my expenses come into that 50% of my income? If it comes over a little more, 55, 60%, fine. But if it's like 80%, that's worrying, because what about your wants? What about if you want to meet up with your friends or do things you love? And what about your savings?
Yeah. And then it comes to that kind of working yourself into the ground to achieve the musts.
Yeah.
But then also there's no want.
Exactly. Yeah, and I just think that's terrible. I always tell people, like, you just don't want to be miserable. Some people that, you know, they come to me, they get into debt, and they're like, how about if I work 3 jobs? And I'm like, you're gonna be miserable.
Yeah.
Like, look after your mental health. I always say that when it comes to money, like, please don't burn yourself into the ground to do this, or to maybe live a lifestyle if you feel like you won't have time for yourself.
Yeah. And mentally, money worries are the worst worry, right?
Yeah,
I think, you know, we discuss that in like groups of friends or family, and, you know, I've seen that over the years with my mum and myself, and obviously now my finances look a lot different and I'm very grateful for that, to how they once were. But that feeling of not making ends meet, the feeling of everything spiralling, and it all comes down to not being in an okay financial situation. Like when your worry is only money, but that is such a big worry, because, you know, not having it and not having the kind of ability to be able to support or to be able to do what you need to do, and knowing that you could have the rug pulled from under you at any moment, there's nothing that quite sort of touches your mental health like that, you know?
Yeah. And I agree on that sentiment of like, how I grew up is different from how I'm living now, and I'm so grateful for that, because just kind of seeing my mum struggle and stuff like that, I always knew from growing up, I was like, cool, money's a really big thing. I remember being young.
It made me very aware.
Rush into work. I said, oh, this workplace is really important.
Yes.
It's really important to people. And I was like, oh, okay, it's the money and stuff like that. So I've always been like, I need to be careful growing up, because this thing is quite serious, and I don't want money to control me. I don't think it should control anyone.
No, and it really does. And I think that, like you say, that's a worrying place to be in. When we talk about personal income and we talk about, I suppose, personal banking, personal finances, and we're breaking down the 50, 30, 20 rule. When it comes to business, does the same rule apply? Do the numbers change? How do you think that looks? Because obviously, when you start, there's a lot to break down, whether that's budgeting for, you know, I run a product-based business, so I'm talking in product-based terms. Yeah. But whether that is for us, it would look like formulation, it would look like testing, it would look like product, it would look like packaging, PR, marketing, everything else to, you know, bring it to light. So when it comes to budgeting early days in a business, what do you think the rule is to follow?
I would actually say with that, just look at the difference between your needs and your wants.
So when I break down that list of things that are going to have to come out.
Yeah, you have to look at, okay, I have to do this to get the product out. So that's a need, and so on. So that lets you know every single month this comes up to X figure. But then you may be working with a PR company, but then maybe there's another PR company that offers something different. What's the price then, and so on. So I'd always say, wherever possible, you want to get the best possible price and the best service, which is, of course, what we all want, right?
And this comes back onto what I was saying earlier, where I was saying, just because your costs fit within that 50% doesn't mean that they are the right costs. That doesn't mean that it can't be lower. And knowing there's so many different softwares out there, and a lot of people get like shiny software syndrome, where they're like, I want that, I want that, I want that. And you're paying, before you know it, thousands out there on softwares that can do the same thing. So it's really being, okay, like for example, where she just said she runs a product-based business, she's got the PR, she's got the marketing. Really, PR is quite a big cost. You're looking minimum £1,000 a month for a good PR company. And is that a necessity or is that a want? Can you still organically put that business out and put that product out? Is it a PR company that you need, or can you run Facebook ads? It's knowing your strategy and making sure that your strategy works with what your budget actually is. So if you're estimating a product launch to be £100,000 and you're going, well, actually all of my wants are £80,000, well, then you're living in 80%, not 50%. And it's about being realistic with yourself and having an honest conversation with it. And just because it may seem like really good and really exciting and you really want to do it and you want to rush and bolt through that like door and be like, yes, I want to sign, want to move ahead with that, is that what your business needs right now, and can your finances manage that? And it's also about looking at the return on investment as well. PR can be a great thing, but it can be a long game. If we take like marketing more, for example, like marketing budgets really depend on the size of the business, and it's also about using it in the right way. It's no good throwing loads of money behind really shitty marketing just because it feels like you're getting your name out there. Everything needs a strategy and that can justify the monetary value that's been spent or is going to be spent.
I want everything for like £1.
Yeah, that's the truth.
So I think it might not necessarily be 50, 30, 20, but I think the key message is the same in terms of what are your wants for the business and how different is that from a need. Because it's very easy when a business is your baby to say, oh, we've got to have that.
It would be great to do this because this is going to make people go wild.
Exactly.
Yeah.
But at the same time, could you live without that? And then just see. So it just depends on how much income you've got coming in and so on. But you all know that, you know, oh, look, we have to do testing. That's an absolute must.
That's a non-negotiable.
Exactly. And that's where the need is. Versus a want could be like, oh, I've got this great idea and I've hired so-and-so person to do that and stuff. Or maybe a supplier says, oh, I can throw this in as an extra. And you think, oh, actually, that may sell well, but we have to choose between our needs and our wants and stuff like that. So that might not necessarily be 50% on your needs. It could be more, especially because it's a business. But yeah, I'd say that's where it differs a bit.
It's so interesting to hear the difference between saving and investing, because like you say, our default is like we should save, but actually, as you mentioned, making your money work harder for you rather than always having to kind of watch it and see what happens with it. I know that you're really passionate about, I mean, I'm really passionate about women, hence why this whole thing exists, but you're really passionate about women when it comes to investing, aren't you?
Yeah. First of all, I just think more women need their money. I'm so big on that. It's so important, and it's okay for women to want money as well. There's currently a gap, so men invest 567 billion more than women, which goes to
what the actual hell? That statistic is crazy. £567 billion more than women. That is staggering.
That there's still this huge gap in space for women to jump in and invest. And I'm not just talking about investing in one way, investing in different ways. Of course, you've got like stocks and shares, but as you said, Yolanda's premium bonds and stuff like that, or investing in businesses, or even investing in yourself. Like what women will add to the GDP of this country if they started their own businesses in comparison to men as well. It will put us in such a better position from an economic standpoint. And I just think just wherever possible, I just tell women, please just get started. You don't need to have all the answers. Because one thing I noticed from a lot of the women I talk to, they will read all the books.
We've read every self-help book going.
Literally, we've read all the books. Here is our plan. They've got the PowerPoints, they've got the briefs and stuff like that. And they're like, do you think I'm good to go? And I'm like, you were good to go 5 steps ago.
Yeah. Do you know what's so funny is Emma Grede said this. And obviously this isn't like finance based, but she was like, when somebody comes to me to look to invest in them, they give me the PowerPoint, the shiny deck. It's got bells and whistles on and it looks amazing.
Yeah.
But she's like, just do it. The best sign of an entrepreneur is someone that takes that idea and just runs with it and says, I've been trying and this is where we've got so far.
Yeah.
That is way more appealing than the kind of PowerPoint presentation.
Exactly, because that's when you have a bottleneck that someone else can step in and help with.
Yes.
Even like I met with my friend and he has a fantastic business and I want to start something similar. And on my way to the meeting, I was just like, Bola, this is your last meeting about this business. I said no more. It's actually enough. Just go and do something and start. Because I was like, I'm sick of you.
Yes, I'm sick of myself.
I was like, I'm sick of myself. Just go and start and see how it goes, and you will get better. As opposed to this whole notion of everything has to be perfect, because everything we put on paper and in documents don't always turn out that way.
Yeah.
Anyway,
100%. I wrote a business plan and it was not really much of a business plan because I didn't actually know, and I could have spent ages procrastinating over this business plan, but it's just take action now, because there is no time like the present, there is no time like now. And when you take action now, you could be thanking yourself in 6 months' time rather than waiting in 6 months' time and still be in the same position, living the same life.
and the best lessons are the ones that you learn from starting and moving forward and being like, oh, I tried that, or next time you can say, oh, be careful of that. And, that's how you build.
Which is so interesting, because when it comes to finances, to me, it feels very, methodical and you must do this because this gets X. But it's so kind of reassuring to know that you also do have to try and see what's for you and find out what sticks.
Yeah, that's what I did. Because even when I started, investing via, the stock market, I just remember I was like, oh, very new at this. When I got started, I was like, very new, I'm going to invest in this. And I learnt different things about different times. And I was like, oh, I don't like this way of investing. So, investing in singular stocks are quite risky in comparison to investing in funds. Mm-hmm. And I was just like, I don't have time to track singular stocks and, check my phone.
Time for risk.
Exactly. Check my phone and be like, oh my gosh, my portfolio is down by so much because it's all dependent on this one company. So I think it's important as well to learn along the way. And that's how you learn about yourself in different seasons, as opposed to just thinking oh, I'm just going to follow this rule because that's the way to do it. Life doesn't work that way.
And when we talk about there's a big difference between a finance expert and an accountant, right? Yeah. So when we talk about maybe sort of teeing up an accountant when, you've been working at this for 6 to 9 months and now you've got a bit of a record and it's probably time to sort of seek advice and make space in the budget for that. When do you think is a good time to talk about somebody that actually helps you with your finances in terms of advice? And, when should young founders be interested in investing, because obviously it's hard.
Good question.
I know that we mentioned about saving and investment, and that's something you can do early on as opposed to saving. Yeah. But when do you think it's time to look and say? Because I think the most, in my mind, when I think about progression and earning and building, you want to make sure everything's sorted personally. Yeah. I don't really think of let's invest in this which is probably not a great mindset to have, as you've just mentioned. But I think of, okay, and my friend has said this to me, so it'd be really interesting to get to your take on this. My friend said, you're worrying too much. I think the working class mentality in me will never leave. The fact that me and my mum was in a hostel, and then we went to a council house, and then it was like a lottery room the day that she bought the house from the council. Yeah. So my mindset has always been, own your own house. Yes. Don't have a credit card. Only use a debit card. And, work hard to pay off a mortgage, or make more down payments than you need to. Yeah. Because that is drilled into me to own it, because no one then can ever take it away from you. Yeah. But then when I talk to my friends that understand that and haven't sort of had probably the same upbringing as me, and are way more well educated in that, they're like, that's wrong. Why spend your money when you can spend a bank's? Or why spend? And
and this is where the conversation of debt comes in. Debt can be the most detrimental thing or the most rewarding thing in your business, and it's all about how you use the debt and what type of debt that you use. If you're using debt, so a bank's money, a credit card money, whatever it is, someone else's money, an investor's money, it's great to make sure that that investment is into cash flowing assets. So things that's going to bring in money and make you money. There's no point of investing in something quite heavily that is not going to make you money. And a great example of this is cars. We know that majority of cars depreciate in value rather than appreciate, but things like property typically go up in value, land goes up in value, and it's as long as it's making you that money back, or there's a reward out of it, like personal development, if you are investing in yourself and in your knowledge in order to go and make that next big deal save, in order to go and build and scale to the next area of your business, it can be the best thing you do. However, if you're not good at managing money and you're not too sure, that's when debt tumbles, interest rates spike, you don't move, because you can move money from one credit card to another, you're not moving like balance transfers properly, you're not managing your interest and not paying back in time, or not having a strategy on how to tackle your debt. There's two main strategies that you can use, and you can use the avalanche method or the snowball method. So the snowball method is, okay, let's attack, like if I've got 3 different types of debt and this debt's £100, this debt's 100k, let's say £1,000, £100, £1,000, and then you've got a debt that is, let's say £5,000. The snowball method is, right, let's get that £100 done. Let's build up the momentum and attack one by one. So pay like minimum amounts across the 2, and then try and clear off that £100, and then go clear off the £1,000, then go clear off the £5,000 while making the minimum payments to all of the debt. Then the avalanche method is looking at what debt has your highest interest rate on it. So is it a credit card that has 27%, for example? Go and attack that first, because the more that you bring that value down, the less the interest is going to be, because there's less amount of debt in order to accumulate the interest. So there's 2 methods for you to do it, but really using somebody else's money in a strategic way that's not your own can be really, really, really beneficial for your business.
Challenge me on that, and I think that there's something mentally that I'm like, I just want to work hard till I have no mortgage. Like that is to me like the biggest life dream. And they're like, okay, well, if that's going to satisfy you mentally, that's one thing. Yeah. But actually use a credit card. Yeah. Why are you using your debit card? Like there's things that we really disagree on. What's your take on that?
Who we become, even like financially, is so dependent on our childhood and how we saw money growing up, and the decisions that we made and the habits that we formed. I think I get the paying off a mortgage being a dream, but I still think it's important as well to use other people's money where possible, because that's how, depending on how you feel about risk, you can grow and make more money. So some people, they don't just have one property. They're like, actually, if I have a few properties, then I can use this for my pension, I can use it for like my kids when they grow up and stuff. And some people are like, no, I just want to have one property. It really depends on how you see risk and what you're comfortable with.
And what your idea of success is.
Exactly. Yeah. But it's so important to maybe push yourself into your why, because you want to make sure that once you hit that pinnacle of success, you don't feel stumped. You don't feel like, oh, is this it? Yeah, like in some ways you were able to challenge yourself. But yeah, I mean, I get where your friends are coming from, because sometimes I do that. I have to push myself, and I'm like, really? I'm a bit scared.
Yeah. And like, look, even the idea of having a credit card terrified me until a couple of years ago.
Yeah, a lot of people have that, actually. A lot of people.
My mum was like, they are bad. I think she just, when I was younger, thought that I would get a credit card and just completely blow it, which I did at one point. And then not, and then that becomes debt that's negative, where actually it can be debt that's positive. Exactly. And I think it's changed our mindset. Like, not all debt is negative. The word debt just terrifies me.
Yeah.
But it actually isn't, you know, it doesn't have to be a negative, does it?
Yeah,
I think this really comes from, as she says, like a working class family mindset, but not even just working class. It's a very British mindset to have. And if you're in the UK, there is a massive taboo around money. Like, you can't say how much you get paid because it looks like you're showing off, and or you can't mention what's on your pay slip, and you're not supposed to go into debt. Like, debt is bad. And as you said, like, putting money on a down payment for mortgage, like extra money down. Imagine if you put an extra like £200 down into a stocks and shares ISA that grows, and then you've got more money at the end, and you're still going to clear off a mortgage because you're still making your minimum payments, but you've been growing your money elsewhere that if you wanted to, you could take that out and then clear off your mortgage, but you can then go spend it on other things that is cash flowing assets. So you go and put it into property, as Bola just said, like put it into property, rent out a property, and you can get minimum £500 a month, depending on the size of it, location of it, XYZ. But if you're getting £500 a month, that's £6,000 a year. Like, you're laughing, innit?
debt and there's bad debt. So I think like running up a credit card and not having the means to like pay it back, and then kind of having this huge balance, meaning that you are incurring interest, is bad debt. But for me, good debt is, I don't know, like a student loan. Like, I got a student loan, and that to me is good debt because I studied maths and finance. I'm still in finance today. So that to me is an example of good debt.
I think this one is really about your perspective. See, I see student loan as negative debt personally, because I think, as I said, I didn't go to university. I went for apprenticeships, and I got to learn while having my qualification paid for me and being paid myself. And I get it, not every avenue that you decide to go down in life can be through apprenticeships, but if you can, I recommend it massively, because the average debt for a student loan is like averaging around 50k per person. There is currently, I think it's over £240 billion in the UK of outstanding student loans. Don't quote me on that, but I think it's around that figure, which is crazy, because then that's in debt to the government, and they're bringing down like how often you have to pay back your personal loan, and then that's money you're having to pay back for the next 20 years, 25 years, whereas I didn't have that and was getting paid and learning from jump. So it all depends. It's all relative, I guess.
When it comes to credit cards, you just have to have financial discipline. So when people say to me, should I get a credit card? I ask them, do you have financial discipline to have one, to have it? Because everything can't be an emergency and stuff like that. Like, you can't say, oh, I've got to do this. Or I hear, oh, I've got to get the kids presents. I've got to do this. And I'm like, do you really have to? And especially if you know you don't have the means to like maybe pay it back, and now you're paying more for the presents because you just felt kind of that you had to.
So when it comes to like a credit card, for argument's sake, it's bad debt when you're putting something on the credit card that you was going to take you that you can't pay straight away, but you should use the credit card if you can.
Yes, yeah, use it and build up your credit, because it also shows your discipline and shows that you're trustworthy on the basis that you are paying it back, and you will see your score go up on that basis. But if it's like you have a credit card and it's got a £10,000 limit and you use up 8,000 of it, then it looks as if to say that you're a bit too dependent on that, so that can bring your score down. But if you use, let's say 30% or less, so that's maybe 2 to 3k, it looks like, okay, you use it from time to time and you know how to manage it well.
But then say you use it and your limit is £5,000, you've used £2,000 of that credit card. You have the means to pay the £2,000 off.
Yeah.
Should the preference always be spending it on the credit card versus the debit card?
I think it depends on what you're getting. So with a credit card, you've got the like Credit Consumer Act, which means anything that you buy which is over £100, you are essentially covered by that thing. So for example, if you were to take a flight somewhere and you booked it on your credit card, and then maybe the airline goes bust and stuff like that, your credit card can help you recoup that that money.
Yeah. Which you couldn't on a debit card.
Correct.
Right.
And I know this because this has happened to me. I literally flew for my sister's wedding and they had no flights back. And I booked it on my debit card and I left my credit card at home and I was so angry because I knew this. But
see, even the experts get it wrong.
honestly, it's so important. They say that, literally. And I was like, Bola, what are you doing? And I had to tell my brother, and he's the oldest and he's an accountant. And he's like, what are you doing? And I was like, I don't know.
I don't know,
but please help me.
I'm going against my own messages here.
Literally.
Okay, so for that layer of protection, but then also for credit score, and if you're seen to use it and constantly...
Yeah, do well with it. So if you're managing your money well, then what it means is that the next time you want to apply for something on credit, they're like, okay, great, we can trust you.
Yes.
Whereas some people, if they abuse it and so on, I know, so, you know, I've seen public stories of maybe influencers who've made a lot of money, and then you think the next step is for them to buy a house. And some of them have come out and said, I was really bad with credit. I have the money. I don't have the credit, so they don't trust me to pay off the mortgage and stuff like that.
Yes.
So now I have to rent for another 2 years and stuff like that. So it's so important.
So that's so interesting, actually.
Yeah. I always say that if, like, cash is king, credit is queen. Like, you just, like, don't play with credit. Yeah.
Oh, I love that. I ask every guest, whether that's on the launch box or whether that is, you know, our episodes weekly, to leave a tip, something tangible that our listener can take and do today and make action today. So if a lady's listening that wants to start a business from a financial perspective, what do you think is something that they could do to sort of put that into play today?
Yeah, I would say in your business plan, have an idea and have a forecast of your business in year 0, year 5 and year 10. I think that those are kind of key markers, and it allows you breathing space to let your business grow and to see.
I think 3-year forecast myself. I hear what she's saying, but the thing we've all just said, like, with businesses, you don't know whether your business is going to survive, and it's great to have an idea of where you want to be in 10 years' time, but the truth is your business might not even go down the same route as what it would do, and you could either have exceptional accelerated growth. I think a 10-year forecast is just too much. It's far too hard to understand and envision where the business is going to be at that point, because so much can happen in 10 years that is just, it's irrelevant spending the time on it. I think it's great to have an idea of where you want to be and an end goal in play. But I think having a forecast is a bit counterproductive, if I'm honest. I think 3-year forecast, understand how to get through, maybe even a 5-year forecast, like 1 year 0, year 1, year 2, year 3, year 4, year 5, like all the way up. So you've got an idea of how you're going to grow, how your spending's going to look, what your profit's going to be looking like, how you reinvest your profit back into that business, so how much money you want to be taken out of it and when by, have all of that built in so you are creating something that is sustainable and that is readily achievable for you to be able to monitor and track against, because that forecast technically would act like a budget. You can use that as a budget. Yes, you're going to manipulate it, you're going to have to compare it to your actual performance. Like year 1 you could do nothing, year 2 you could absolutely skyrocket, and that forecast is no longer relevant. So I think having a 1, 5, 10 years a little bit counterproductive in my opinion.
What type of numbers you're trying to hit in those different years, because it also gives you time and allowance to get to that point and maybe look at marketing strategies, for example, of how you're going to get there, because comparing year on year, it's next to each other, so sometimes it might not be as much as you thought, but if you give it that space and that time, you're able to maybe change your business plan slightly or tweak a few things to be like, this is how we jumped and got to that next figure,
and this is how we grow.
Exactly. And just know that, you know, also ask yourself, I always say as well, maybe ask yourself what's your number, which can change. Like if somebody came and said, hey, I want to buy your business, what's your number that would make you say, okay, this is what I'd sell it for, and so on.
Okay, so it's almost being, when you're starting, it's almost, as well as the business launching and that be exciting, you've almost got to think about the future at the start.
Exactly, because even the like accounting records you keep and so on, if anyone comes into your business, whether that's as a partner or an investor, they're going to want to see that and see how everything's run. So also kind of think about staying organized.
Mm-hmm. Okay, well there we go. I feel like I've got a lot of organising stuff today. I'm with myself on my own messaging that next year everything's going to be smoother when it comes to tax return.
It will. We're all trying to get better with that. It's all a work in progress.
Yes, thank you.
Thanks for having
me.
So
much.
Thank you.
Wicked. Well, that is my first reaction video. Lengthy one, probably. Yeah, I've really enjoyed listening to that podcast, especially like a second time around as well, like properly listening to it, diving into it and talking through it as well. It just shows that everybody has a different opinion. Every finance professional is different within their own right. And what one person says isn't necessarily wrong. It's just their opinion and you've got to make it work for you. So yeah, that's me, Nick at the Ginger Accountant. Peace and love. Till next time. Bye.